Hello class and welcome to our last lecture series on principles of accounting or financial accounting, and I'm your instructor Dr. Jamel. So I have a big announcement to make that our final exam is going to be on next week on 29th of June, okay, the same time, okay. So regarding our paper pattern, it is same like midterm, in which we have part 1 and part 2. So part 1 is mostly, I would be uploading the answer sheet like what we did in our midterm. So all you need to do, just fill out the answer sheet with your name and send it to me during the specified time. So I hope you understand why I am, I'm making time restriction on part 1, so that, I should, reward those who are high achievers or who are working hard to get the scores. Okay, so I need to be very, equitable, and to maintain the justice, I would be limiting the time period so that we can narrow down. Of course, you know, this is the age of internet and all the stuff. You are very smart people. I do acknowledge that. So we cannot 100% eliminate the opportunity of cheating, but we can narrow it down. So we can narrow it down to the minimum level, so that no one have enough time to exploit this final examination and cheat those who are working hard. So I hope you do understand why I am having limiting the time restriction on part 1. For part 2, I would be giving you ample time to complete part 2, because that is more numerical based. So you need to write down the entries, solve for the for example the bonds, interest rate and all those stuff, bond valuation, recording of the bonds, accounting for liabilities, accounting for depreciation. So regarding final, so I would be including after I don't know why it's not writing here. Let's write through mouse. So after mid, what we have covered, right? After mid, sorry about my writing. So after mid, what we have covered? We have covered cash in our midterm, right? So account receivable, inventory, plant assets, and then we covered current liabilities, long-term liabilities, and the last one today that we talk about, the owner's equity, right? So any question regarding our final exam? Ella, Jun Kim, Nam, Kenya?
No questions.
Okay, let's move forward. Okay, so in our previous class, we have covered the how we account for long-term liabilities, and long-term liabilities we talk about the bonds payable, and in that bonds payable we talked about specifically the accounting for bonds that are issued on par value, and then accounting for bonds that are issued on discount, right? And today we'll talk about the accounting for bonds issued on premium. And in continuation, let's talk about how we calculate the partial period interest rate. So remember, if our period of interest payment is within the accounting period, then there is no liability. We just pay through cash. But if the accounting period is closed and payment is after the accounting period, then remember to create liability. Why? Because we know the matching principle that the expense that belong to that period must be recorded in that period, right? So that expense for 2000, for example, 14 will be recorded in 2014 income statement. Rather, it moved on. Whether the payment is made on 2015, 16, whatsoever, but it would be recorded in 2014. So we can also calculate the partial interest. For example, 3 months interest, 4 month interest, 6 month interest, 8 month interest, right? We can also do that. So remember the interest rate that are given to you would be given as an annual interest rate, right? And the payment structure, that how it will be paid, will be given to you, next word, or maybe in the next line. So here it is written semi-annually interest, which means 9% will be given to you whole year, but payment would be half of the 9% will be given in 6 months, and next half of the 9% will be given on next 6 months, right? So let's talk about this partial payment or partial period interest rates. So here we go. So we have illustration that Google Incorporation issues 100,000 of 8% bonds payable at 96 on August 31st, 2014. So this bond is issued at discount or par or premium. So remember, this is issued at 96, which is mean that it is issued on 96% of the value, which means 4% discount, right? So it's not issued on 100%, which means if company is promising to pay 8% on the value of 10,000, but you don't have to pay 10,000, you don't have to pay 100,000, you will pay right now 96,000. You multiply 0.96 with the amount here. So this is like a percentage, right? So you see, discount is 4,000 and amount received 96,000. So the bonds have interest of 9%. The market interest rate is of 9%, and bond payable interest, which is coupon, is 8%. Okay, I confused with 9%. So 8% is coupon and 9% is market interest rate. So this also makes sense why this bond is issued at discount, because market is giving us higher interest rate and we are, as a company, issuing the bond at lower interest rate. So that's why our bond will not yield or will not result in 100% collection. So we need to offer discount 4%. Now, the first few lines of the Google's amortization tables are following here. So you see, it is issued on 31st of August, which means September. So we need to calculate the interest rate from September, right? But remember here, next 6 months going to be September, October, November, December, January, and February. And remember, Google here, accounting year ends on 31st of December. So how much interest expense belong to 2014? September, October, November, December. 4 months, right? But company will give 6-month interest payment to the customers or to the bondholders, not customer, to the clients, bondholders, on February. So we make the amortization table. We know that 4%, 8%, half is 4% payment, interest expense always on market interest rate. So I'm not going into the detail how we calculate it, because discount we already covered in our earlier lecture. So remember, this is 6 months, and this payment and this interest expense This is 6 months. Out of the 6 months, 4 months belongs to 2014. So we multiply this 4,000 multiplied by 4 months, 4 by 12. And this interest expense 4320 multiplied by 4 by 12, 4 months. And we record it in our 2014. Here we go. So interest expense to discount on bond payable to interest payable on December 31st, because December 31st we are not paying that. Payment is in February. So that's why we create interest payable. Right? So this entry is now balanced. Why? Because discount is also covered, is credited, because as time passes, discount is basically added back to our value of the bonds here. So you see 96,000, 96,320 and 96,000, because at the end the carrying value of the bond will meet its par value, its face value. So carrying value of the bond increases to bond value, face value or maturity value at the end of the expiration. So we need to decrease the amount of discount and add back to our bonds carrying value. So this illustration is because we want to find out partial payment interest rate. 4 months payments are made after 6 months, but in these 6 months 4 months belong to previous year. So we record it in previous year 31st. Entry is the same, just we are not paying cash, we are creating liability. So this will go to income statement of 2014. So that's the real point here. So why discount is 213? Why not 320 here? Right, 320, because discount 4 months discount belong to 2014. So we also multiply this discount 4 by so 4 by 6, not 4 by 12, 4 by 6, because this is 6 months interest rate. Sorry about that. 4 by 6, not 4 by 12, because this is 6 months payment. I made a mistake. So 6 months payment, total 6 number of period, 4 periods belong to previous year. So 4 by total number of period are 6. Okay, so are we clear here? Ella, Marilyn, Pinyu, Nam, Hunjin Kim, understand?
Yes.
Yeah.
Okay. Now here comes the next part, which is issuing bond payable at premium. So what is the case when we issue the bond at premium? It must be the case when we are giving higher interest rate and the market is giving us lower interest rate. Right? So here we go. The illustration is that on January 1st, 2014, pay very close attention to the dates here. Southwest Airline issued 100,000 of 9% 5-year bond when the market interest rate is 8%. Right? Even if this is not given, you automatically know that it would be a premium bond. So how much is the premium that we are receiving? Above the face value is 100,000 or maturity value is 100,000, and we are receiving $4,100 in excess. So that is very interesting. So it means after 5 years we will pay them 100,000, but right now we are receiving 100,000